A very good morning to everyone. Thank you so much for joining in. So, the crisis is dying down now. So, we're all talking, we've been talking about the Middle East crisis all this while, and now we are seeing it step. Question that should come to your mind as an investor next is your portfolio ready for it? So, over the last few months, as I said, all of us have been through something quite unusual, including the markets. A war that started in the Middle East, which has quietly traveled into oil prices, shipping routes, the rupee, and eventually also into our portfolios. So it shook our macroeconomic picture itself in ways that nobody anticipated at the start of 2026 when things were looking stable for us. But here's the thing. Um, just as conditions weakened faster than expected, they're also improving now faster than most investors are actually realizing. Today, what is this going to be about? What am I going to be talking about? Is not about geopolitics. It's rather about your portfolio, how you should be thinking of it, right? That is going to be the agenda of this webinar, right? It's not going to be about predictions. It's going to basically look to provide you with a roadmap of clarity, right? That with that being said, we can move to the next slide. So, to just put facts on the ground, on 17th of June, the US and Iran signed a ceasefire, which is an MOU, giving both sides a 60-day window to work toward a final peace deal, right? So, the Strait of Hormuz, through which nearly 20% of the world's oil flows, is reopening. Oil Oil has already corrected to approximately $73 per barrel as of a couple of days back. So that is almost 40% below its wartime peak, which was above $120. So to put that in perspective, the single biggest shock to India's economy, this has already probably partially reversed, is what I can say as we speak. Gold, which had reached near record highs of approximately $4,000 during its peak, has also softened. Safe havens are less in demand, so it's not behaving the way it should ideally be behaving in a warlike situation. And that tells us something very important about where sentiment is moving, how the usual playbook is something that is not working in this crisis and not something we can rely on going forward as well. So right now we are in a position where you know we cannot be like, oh, the war is over, because the ceasefire is in process and a final deal will take time. So there we should be prepared for more uncertainty, more noise, more news. But how is it that in today's conversation, what does the easing of this crisis itself mean for how your money is positioned? That is something that we have to ask and be prepared for, and also keep our portfolio prepared for. So, just a couple of series which I would want to highlight over this slide is, many of you may have wondered why a war between the US and Iran and the Middle East become a problem in India, right? So I think there's a saying called if America sneezes, the whole world catches a cold. And that's exactly what has been playing out as well. So let me just trace the chain of events to give you a perspective of where I'm coming from. So this is important to understand because the same chain now seems to run in reverse. And that reversal is what is bringing you the opportunity and bringing opportunity for your portfolio. So at the beginning of the year, our macro picture, as I said previously, was actually quite encouraging. The banking system has been in reasonable shape, sectoral fundamentals were broadening, and then the Strait of Hormuz got disrupted. There was the whole war breakout, and it went on for a good, more than 2 months, right? So step one was the supply shock. So the strait got blocked, choking the oil supply, and we import almost 85% of our oil. So overnight, the import equation itself changed. The next step, the prices spiked naturally, right? Crude moved from $60 to above $120 per barrel. Freight costs surged simultaneously. LPG, diesel, fertilizers. I mean, the cost of everything that moves through a ship basically went up. The next step, or what this further led into, was the rupee being weakened. So when so naturally, when the import bill balloons or when the import bill is increasing, the current account deteriorates and the rupee comes under pressure. So we saw like a double-digit weakening against the dollar, something few had anticipated even in early February. After that, this led to the FII outflows. So, foreign portfolio investors, many of whom are energy exporting nations, began withdrawing capital and they were diverted further towards Korea, Taiwan, wherever they found further opportunity, right? They were driven by that. So, the magnitude of this withdrawal was extraordinary. More money left in the Indian equities in 5 months, more money left out of the Indian equity system in 5 months than the entire previous year, right? And this further led into the markets being strained. So blue chip companies, which is the large cap companies, the highest quality businesses, as we say, bore the brunt of these outflows and indices fell. So the sentiment deteriorated faster than anyone expected. And while I might say that this was a series of events, it was not one by one, or it was not something that was predictable. It just happened simultaneously and very quickly, even before any investor or anyone could observe or even process. But now, I mean, here is what you need to basically hear clearer. This is what you need to understand. That's this the same chain is seems to now run in reverse. Basically, the oil is falling as we speak. The oil is falling. Freight is normalizing. The rupee is stabilizing, aided also by RBI measures, including, bearing the hedging costs on FCNR deposits and the government exempting foreign investors from tax on government securities. So FII outflows are kind of slowing. This reversal has already begun, but FII outflow slowing doesn't mean that they're going to come back immediately. We probably have a long way to go there as well. So, what I'm trying to say is that this reversal, as we speak, has kind of begun. So, most investors, we feel, have not yet positioned their portfolios accordingly. And that is the exact gap that we are here to close. Right. So, moving on, before I go on and talk about what to do, let's make sure we are on the same line and we're speaking the same language about what a portfolio should actually consist of right now, right? So, your portfolio is not standalone, it's not one thing. It is a collection of, let's say, different types of assets, different types of funds, each of it behaving differently in different market conditions, right? So the war changed the relative attractiveness of each of these in a very specific way. So that's what we're here to understand first. So equities or stocks. So this is basically the best place to be in at this point. These are your growth engine companies, businesses over a long period. They compound wealth they seem to compound wealth better than any other asset class. And given the uh, uh, risk trade-off scenario, it is to be in equities right now is something that we're actively looking at. So as of now, equities have been under significant pressure, but that is precisely when the most durable wealth creation opportunities emerge. So businesses haven't changed, their prices have. Many bottom-up stocks are quite cheap in terms of valuations, which we want to capture. Large caps, historically cheaper, that we would definitely want to capture. So equities is the place to be in as we speak. Energy and commodities, so oil, gas, metals, these assets were the winners of the crisis. So the oil shock drove energy stocks higher. So now that shock is fading, that and the wartime, the premium is basically now looking to reverse. So this a part of your allocation towards this is also important. Now let's talk about safe havens. Gold is considered as a safe haven. It was supposed to protect you, right? So it disappointed us during this particular crisis. As I said, the asset classes have not been using their usual playbook or acting their usual way in such a crisis. And that's exactly why we need to rethink our decisions as and when such crises arise, because we have seen it that gold has not been working the way it should. So no single asset class at this point we feel can be a perfect hedge as conditions normalize. The case for holding large amounts of gold weakens, right? So bonds, on the other hand, maybe are kind of becoming interesting as interest rate expectations shift, but definitely equities is something that you should further be scaling up. Finally, cash and liquidity. How much cash should you keep? Many investors, they say are uncomfortable maybe holding just in cash. I'm losing interest, this, that. So it feels unproductive, right? But in a market like this where um, volatility continues and individual opportunities emerge at different moments, liquidity is not idle money, it is optionality. It's basically the ability to act when others cannot. So you need to maintain some amount of liquidity so that you can participate as and when now and then the market is providing an opportunity. So the question is, across these four building asset, I mean, across these blocks, how is your portfolio position today? Is it built for where we were, or is it positioned for where we are going? All right. So this slide, um, it captures the single most important thing happening in the markets right now. So during the war, investors did exactly what they always do under fear. They moved into protection. They sold what they didn't understand and bought what felt safe. Oil and energy surged, as I said. Safe havens were in demand. Quality equities, blue chips basically, faced the most aggressive selling. But why were blue chips or large caps hit the hardest? Because FIIs owned them the most. So when FIIs exit, they exit what they can sell quickly, and they can sell quickly. What they can sell quickly is large liquid index heavy stocks, not the smaller ideas. So the best companies is what they can sell. So what happened? Like what happened after that, right? The best companies now have become the cheapest. So now you're able to correlate what I said in the previous slide and what I've been telling now, right? So the less well-run, less liquid parts of the market, basically the domestic investor-driven pockets, held up relatively better. So a peculiar and somewhat irrational market is what we are in at this point. But that is what happens during a crisis like this, right? So now, as we see the calm returning, everything is kind of reversing. Oil is down, safe havens have not been acting the way they should, and blue chips are being hammered the most and have become the most attractively valued. So many, or additionally, many of the best private banks in India are now available at price to book multiples of around two, levels that historically have been excellent entry points, right? So there's consumption as well. There's telecom that has been that has been attractive. So when you look at a business that is sound, growing, and well managed, you see it is available, and you see it is available at the lower end of its historical valuation band. The question is not, should I buy? The question should rather be, can I gather the courage to act while fear still lingers on me? So you cannot predict volatility, neither can I. None of us can do that. But what you can always prepare is to respond when volatility gives you the opportunity. So that is what is the moment we are in right now. And that's what has been further highlighted in this slide also. So now we know, now at this point in time of the webinar, we know the series of events that have happened, what looks attractive, what is it that should be done, right? Now, let me talk about something that I think is more important than any market call. So, which is basically investor behavior. And that's exactly what I'm here for, to address that exact thing, right? So, I just want to share maybe a pattern that I have observed across that we have been observing across multiple market cycles, and which we have seen play out with a particular intensity, right, in the last couple of months. So here is what the typical market cycle looks like from inside it, like just as we speak. In years 1 and 2, like just maybe we can visualize this. In years 1 and 2, no meaningful returns, portfolios have been moving sideways. Patience is something that gets tested. You see your neighbor or you see your friend making money in real estate, you see gold go up, you're just asking yourself, why am I in equities? And this is a real time question that we've been getting as well. Then let's move on to, after year 1 and 2, let's move on to year 3 and 4. This continues. The market is still quiet. The temptation for you to exit reaches its peak because you've been hearing so much that, oh, I've made money here, I've made money here. So the temptation itself to exit and do what has been working increases. So some investors will sell maybe in years 3 or 4 after waiting it out in year 1 and 2, and they move to safer alternatives or what has been already working, right? So this is typically when most wealth destruction happens, because not because the market is not moving or the market is falling, but because of investor decision of waiting it out for 2 years and then becoming impatient in years 3 and 4, then moving out of it and putting it into something that has already worked. So you're paying more for something that has already worked. And then there's somewhere, let's go to now year 4 or 5, when times begin to shift. So the returns start to slowly emerge, and the 6th year is good, the 7th is great. But investors now who surrendered or exited in years 2, 3, 4 don't get to capture any of this. They've just been chasing what has been working, right? So we've seen such cycles in repeat, and every time anyone lost patience in earlier investing years, wherever they surrendered, and that was the time when they were punished. So basically, the willingness to wait is perhaps the single biggest differentiator between uh, investors who build wealth and those who merely participate in the market. So you need to ask yourself, Who are you? Are you just participating in the markets for the sake of it? Or are you here to make use of the market to build wealth for yourself? And another mistake, which is specific to boring and sideways markets, is that is it is the most probably expensive mistake that investors get restless. They look for ways to act. They feel that staying silent or staying as it is, they are not doing something productive. They don't feel productive if they are not doing anything when markets are in such a crisis, right? So they want to replace underperformers, or they want some movement, and they sell a good company that merely just requires your patience. And they end up, as I said, buying a company that promises excitement, a company that has already run up and already worked, already reached saturation. And years later, that stock they sold initially to buy something mediocre is the biggest missed opportunity. So just activity for the sake of activity is not investing. So which is something that we've been noticing in such markets, right? So compounding or wealth creation requires patience, not constant movement. This is a myth that I continuously have to act on whatever the market is throwing at me for me to build wealth. No, compounding requires patience. So if you are let's say 2 years into this phase of equities and already feeling frustrated, um, you can just think that this is exactly how it is supposed to feel before any recovery begins. So the market is testing your behavior right now, and you respond to this test, and how you respond basically to this test will further determine a significant portion of your wealth creation in the next, let's say, short to medium term, right? Okay, so four things to do as the crisis fades. Now we know the macros, what has happened, what has been happening, what is working, what is not working, what is the investor expected to do in such a market. Now let's come on to let's cut to the chase. What is it that you have to do? Step one, you need to review your allocation. So your portfolio may still be positioned for wartime conditions. You need to assess it now. And if you're still heavy on safe havens and still light on equities, so then you have to ask yourself whether it still makes sense. So you have to review your portfolio now. So the environment that created that positioning has probably now begun to change. You cannot stay on the portfolio that was positioned for you well before the war or during the war. Number two, and then you have to also further check on the gaps that lie in your portfolio after like reviewing or while reviewing. Number two, you need to now, after reviewing, you need to act on valuations and then give it time. So there is a difference between timing the market and timing your purchases based on valuations. Right now, I've said time and again over the course of this webinar, and I'm sure you've been hearing also, that many quality businesses are at or near the lower end of their valuation bands because of FII selling, not because the businesses have deteriorated, right? And that is when it gives us the time to act. But you don't need to put, let's say, everything at once. You can accumulate steadily. Basically, you have a figure that this is where I have to reach, and this is how much I'll be pushing in this kind of a time horizon for me to reach the level that I have earmarked for myself in this particular space. That's the approach that you need to be following, right? So accumulate steadily, invest at different points. So what matters is that you start right now and your willingness to start and position your portfolio, right? Step three, or the next step, avoid changing good for mediocre. We've already spoken one complete slide on this particular investor behavior, and I cannot say this enough. So the most dangerous thing you can do in this kind of a sideways market is replace a sound, well-run business with an exciting but mediocre idea. So resist the urge. The companies basically you are most impatient with today will be the ones with no returns for 2 years. Let's just assume that. But it may be your biggest contributor in year three or going forward. Last step, already highlighted in while we were speaking on the asset class, is to keep some dry powder. So the ceasefire, as I said, is in process, and the final deal is not signed. So always, it can just be in such a manner that whatever I'm speaking today might just not be relevant tomorrow. So we need to be prepared for any kind of news that can come in and for all kinds of volatility. So that's why we need to maintain some liquidity as a strategy towards investing, right? Having the ability to act when a new opportunity emerges is one of the most valuable things an investor can have in an uncertain situation. Or let's say, even if the opportunity is not emerging, but the existing names that you are invested in are providing a window to scale up, we should be doing that, right? So these four steps maybe might sound obvious as I speak and on the ground, but they're not easy to execute while others around you are panicking, or while your own patience is getting exhausted, maybe by yourself, or you're hearing a lot from others, right? But executing these with discipline is exactly what separates investors who build wealth from those who merely watch it happen to other people, right? All right, let's move on to the bottom line. And let me close with something that we believe is the most important message of today. The direction has changed. Oil is correcting, freight is normalizing, rupee is stabilizing. So we've spoken about this already, right? So, and RBI is trying to make India more attractive to global capital also. So the macro damage of March through May will not be undone overnight, right? The damage that has happened. And recovery will definitely take time, but the direction has just changed. So that is something that matters enormously. Equities, and particularly blue chip that bore the brunt, are now at valuations that have historically been excellent entry points. Again, as I said, not because the business is weak, but because sentiment was poor and liquidity was squeezed out of the space. So that is very different. That is very different kind of cheap, and that's the opportunity. So investor behavior, moving on, is as to just summarize, is the biggest risk right now. Where they at a moment where they replace good businesses with mediocre ones. They're looking to basically destroy the wealth if they're looking to action on any of these. And finally, domestic participation in equities remains structurally strong, and as gold runs have played out previously, as and real estate faces tougher conditions in major cities, incremental household saving into equity. That structural tailwind supports this market over the medium term, if I can say. So markets will rarely wait for complete recovery. They will move ahead of it. That is why that is why what you do in the next few months matters more than anything that has happened in the last six. So just would like to end with a line by Charlie Munger. The big money is not in buying or selling, the big money is in waiting. This is majorly what I wanted to cover over this webinar. Thank you so much, everyone, for taking the time out and attending this webinar. See you. Have a great weekend.